Friday, January 30th, 2026. Silver just got destroyed. From over $120 down to $74 in a single session. Silver dropped 26.91% in one day. The worst collapse in modern history since March 1980. If you are panicking right now, I need you to stop and watch this entire video. What just happened does not make sense. Silver futures closed at 78.53. Spot traded as low as 74 before recovering to 85, one of the most violent sell-offs in history. And here is what nobody is talking about. While silver was crashing in New York, something completely opposite was happening in the physical market worldwide. Physical premiums in Asia had exploded even before this crash. In the weeks leading up to today, Japan was paying over 60% above spot. Dubai was paying 40%. China was offering $8 over spot. The paper price just crashed 26.91%, and physical buyers are fighting to pay massive premiums over that crashed price. Does that sound normal? In any normal market, when the price crashes, buyers wait, sellers emerge, supply increases, economics 101, but not here. The price cratered while the world scrambled to buy physical silver at any price. Something is very wrong. Welcome to the channel. If you are new here, I break down what is really happening in markets while everyone else is distracted by the headlines. Subscribe right now and smash that like button because this is the kind of analysis you will not find anywhere else. Now let me tell you what triggered this crash. The mainstream media gives you an incomplete story. They say Trump nominated Kevin Warsh as Fed chair. They say the dollar rallied. They say this was profit-taking after silver hit 121 on Thursday. All true, but not the whole truth. Three things happened at once. A perfect storm. First, the Warsh nomination. Markets see him as more hawkish than Powell. Less printing, stronger dollar. That pressures commodities. Makes sense. But gold fell 8 to 11%. Silver crashed over 26%. Why? Nearly 3 times harder. Silver was the target. The second trigger proves it. Reuters published a story that crashed rare earth metals. They claimed the Energy Department would restrict rare earth exports. Metals crashed. Silver crashed with them. Hours later, the Energy Department called it false. Misinformed sources, fake news. But by then, liquidations had cascaded. Margin calls had triggered. Algorithms had kicked in. The crash was feeding on itself. The third trigger? End of month. Last trading day of January, thin liquidity, exaggerated moves. Silver had posted over 50% January gains. Massive profits. Combine thin liquidity, surprise Fed news, and fake news triggering algorithms. You get a controlled demolition disguised as market forces. Now for the physical market story. This is where it gets insane. To understand what is happening, you need to know what China did 30 days before this crash. January 1st, 2026. China implemented the most aggressive precious metals export controls in modern history. Silver was reclassified from commodity to strategic resource. Government licensing required. Only 44 companies are authorized to export silver. Government gatekeepers now control 120 million ounces annually, which is 60 to 70% of global refined silver. China exported over 4,000 tons in 2025. They are a net exporter. On January 1st, they shut off the tap. What happened? Weeks before today's crash, physical premiums exploded across Asia. Shanghai was trading above $80 while COMEX showed much lower. Japan was seeing 60% premiums, UAE and Dubai at 40%. India seeing massive premiums and delays. In early January, physical buyers in Japan paid $130 per ounce, while paper said significantly less. Today's crash, those premiums did not disappear. Physical buying got more aggressive. An 80% premium in certain markets. The biggest paper-physical decoupling in history. Gold sees 5 to 10% premiums during crunches. But 80% across entire regions? Never. Unprecedented. Lease rates exploded to 8%. Normal is 0.3 to 0.5%. 8% means desperate shortage. Holders are demanding massive premiums to lend temporarily. COMEX inventories are down 70% since 2020. London vaults are down 40%. Shanghai is at 10-year lows. Some regions have only 30 to 45 days of silver left. This is not short-term. This is a structural crisis, 5 consecutive years. Since 2021, demand has exceeded supply annually. Global mine production is around 835 million ounces. Total demand is over 1.2 billion. That is a deficit of hundreds of millions yearly. 5 straight years. Where does the extra silver come from? Above ground stockpiles, vaults, reserves built over decades. Think of a bathtub. Mine supply is water in, demand is water out. For 5 years, more draining than filling. Bathtub almost empty. Buffer gone. Unlike other commodities, silver does not respond to higher prices. 71% comes as a byproduct from copper, zinc, and lead mining. Higher silver prices do not automatically increase output. Miners mine for copper or zinc. Silver rides along. New projects take 8 to 12 years. No rapid supply response. Meanwhile, industrial demand climbs. 50 to 60% of consumption comes from technology. Solar, EVs, electronics, medical, 5G, AI, defense. These are not optional industries. These are sectors receiving massive government investment globally. This is an unprecedented demand profile. Nearly all the selling this week, US market hours, not Asia, not Europe. When New York opens, silver dumps. When it closes, it stabilizes. Pattern repeating, coordinated. American banks are selling paper contracts, digital derivatives, screen numbers. Asia and Middle East are loading physical bars, taking delivery, draining vaults, removing real metal. One side playing video games, other side taking the prize. For decades, the West has sold paper while the East has bought physical. Now, more aggressive than ever. The disconnect has never been this extreme. Critical question. What happens when paper loses credibility? When physical buyers stop accepting paper prices? Paper to physical ratio estimated at 356 to 1. For every ounce of real silver, hundreds of paper claims. If even a small percentage demand delivery, system breaks. Not enough metal. Breaking point may be close. Today was not just a price crash, it was a stress test. Can paper still control physical? Judging by 80% Asian premiums, paper is losing control. Social media says banks are collapsing from silver shorts. Reality check. If banks were in trouble, stock prices would scream. JP Morgan was near 52-week highs in early January. Banks are not collapsing. But stress exists. Enormous stress. Not in bank stocks. In physical delivery. Lease rates, vault inventories. Gap between paper price and what physical buyers pay. Building daily. Before I show you what this means for your portfolio, if you are finding this valuable, subscribe now. This is a breakdown you will not find on CNBC. Hit like. It helps the algorithm. What does this mean for you? If you are holding physical silver, do not panic. Do not let today's paper price scare you into selling your metal. Look at the actual facts on the ground. COMEX inventories are down 70%. London vaults are down 40%. Shanghai is at 10-year lows. China is restricting exports and treating silver like a strategic weapon. Lease rates are at 8%, screaming shortage. Industrial demand is accelerating with no substitutes available. 5 consecutive years of supply deficits with no end in sight. And physical premiums in certain markets are hitting 80% above paper prices. You are sitting there holding the one thing the entire world is scrambling to get their hands on. The paper price is noise. It is manipulation. It is a game played by institutions with infinite leverage and zero accountability. Your physical metal is worth what someone will actually pay for it in the real world. Right now, in certain markets around the globe, that is way more than what the paper price says. Do not be the person who sells physical silver at $85 because a screen told you to, only to watch buyers in Asian markets pay $130 for that same ounce in the coming weeks or months. Hold your metal. Understand the game that is being played. The shakeout is designed to separate weak hands from strong hands. Do not give them your metal at these prices. If you are holding paper silver like ETFs or futures contracts, ask yourself one critical question. If everyone demanded physical delivery tomorrow, could your counterparty actually deliver the metal? The honest answer is probably no. There is not enough metal in the system to back all those paper claims. The 356 to 1 ratio means you are holding a promise. And promises break when stress hits the system hard enough. Paper silver gives you price exposure, but it does not give you the protection of holding the actual asset when the system comes under stress. And we are seeing that stress build right now in real time. If you are looking to buy physical silver at current levels, understand that physical premiums are exploding in markets around the world. The paper price says $85. The real world price in many markets is already over $100. In some specific markets, it is over $130. If you can find physical silver at reasonable premiums above spot, consider yourself fortunate. That inventory will not last long as more people wake up to what is happening. And here is the paradox that most people miss completely. The lower the paper price crashes, the faster physical silver disappears from the market. Lower paper prices create more physical demand from smart buyers who understand the disconnect. More demand drains supply even faster. The crash is actually making the shortage worse, not better. This is the opposite of how normal markets work. Now let me talk about timing. The timing of today's crash was not a coincidence. It never is. End of month, end of week, options expiring, futures contracts settling. This is when big moves happen, when they shake out weak hands and transfer wealth. January was the biggest month for silver in decades, over 50% gains, a historic move that got everyone's attention. On the very last day of January, they crash it hard. Send a message, create fear and uncertainty, force liquidations from over-leveraged positions. This is how wealth gets transferred in markets, from emotional retail traders who panic sell at the bottom to patient institutional accumulators who understand the bigger picture. Your fear becomes their buying opportunity. Your panic selling becomes their accumulation zone. But here's what they did not expect this time. They did not expect physical premiums to remain this elevated during the crash. They did not expect Asian buyers to step in this aggressively. They did not expect China to lock down exports this hard and treat silver like a strategic national security asset. And they did not expect more people to see through the manipulation than ever before. The paper market is losing credibility, slowly at first, then all at once. And once credibility is lost in financial markets, it never comes back. Eventually, price discovery will shift away from New York and London. It will shift to Shanghai and Hong Kong, to markets where physical supply and demand matter more than leveraged derivatives and paper promises created out of thin air. When that shift completes, the paper price becomes completely irrelevant to the real world. Only the physical price will matter. And that physical price will be much, much higher than anything we are seeing on COMEX right now. Let me leave you with this. Today, silver dropped 26.91% in a single day, one of the worst drops in modern history. But while it was crashing on paper, physical buyers in Asia were paying 80% premiums over spot in certain markets. Lease rates hit 8%, literally screaming shortage. Inventories are at multi-year lows across every major exchange in the world. China is restricting exports and reclassifying silver as a strategic resource. 5 consecutive years of supply deficits with no end in sight and no new major supply coming online. Industrial demand is accelerating because of technology sectors that simply cannot function without silver. These are not optional uses. These are critical applications. The paper price went down. The physical metal disappeared faster. One of these is lying to you. And it is not the empty vaults. This is not a normal market anymore. This is a broken market, a manipulated market showing its fractures, a market where paper promises are confronting physical reality. And in the battle between paper promises and physical reality, time always reveals the truth. Based on what we are seeing today, that truth is coming faster than most people expected. The question is simple. Which side of that equation do you want to be on when the paper market finally breaks completely? And in the next 48 hours, I will be watching 3 specific indicators that will tell us whether this crash is the beginning of the end for paper silver dominance or just another shakeout before the real move higher begins. Make sure you are subscribed so you do not miss that critical analysis. If you found value in this video, subscribe to the channel right now. Do not wait. Hit that like button and drop a comment telling me whether you think paper or physical will win this battle in the end. I read every single comment and I want to hear your thoughts on what you are seeing in the market. Are you buying this dip? Are you holding? Let me know below. Watch another video here to stay ahead of what's coming next.